Welcome to the Dividend Talk podcast, episode 64. Dividend Aristocrats that nobody talks about. Hey everyone, welcome back to another episode of Dividend Talk. This week we have a jam-packed show for you. We're going to talk a little bit about 4 companies that nobody really talks about in the Dividend Aristocrat land. We're going to talk some news of the week. We have lots of questions from our community, and we're going to do some portfolio reviews as well. So stay tuned. If you haven't already done so, please like us on YouTube, Spotify, and any channel that you're listening on. And we will see you on the inside. Gee, European DGI, what are we going to do tonight?
The same thing we do every Friday, EMF. Talk about dividends and take over the world.
I really like that image that you put up on Twitter the other day. I think it was brilliant.
Yeah, I mean, I grew up with Pinky in the Brain, right? And I really loved it. And it's not to say that you're stupid or that I'm looking depressed, but it's always the same right during the week. Like it's either you or me asking, like, "Gee, what are we going to talk about this week?"
Yeah, and usually it's last minute too. It's like Thursday night. We're like, oh, we have to prep for tomorrow. So
yeah,
no, it's
nice one.
Very funny, very funny. So let's talk about some Apple. I think they're big in the news. You're a shareholder. I know we talk a lot about Apple on this show. What are your thoughts about this new ruling that's going to make them go bankrupt?
I'm not surprised. Yeah, let's say like that. When companies become so big, you get this monopolistic behavior. You get lawsuits. Google has the same, and I think governments are typically, favoring also sometimes the small guys. In this case, Epic Games. Epic Games has the money to have a good lawyer, and now they got a favorable ruling here, I would say. But I think we owe it to our listeners to put it a bit in perspective. So if you think about what Apple earned, I believe in the last quarter it was 81 billion. 63 billion of that came out of products. Service. This is not a service category, so it's 17 billion in services, which means that a part of that is at risk. Let's say maybe 10, 15%. If that is at risk, their quarterly growth rate in revenue increase is higher than the money that's at risk. That's how I look at this. So long term, of course, it might open up the door for more these kinds of things, right? Monopolistic charges via courts, and also other companies like Facebook or Google. I think this might set a precedence for others also to take the courage to start going to court. We had, of course, a chip war between Qualcomm and Apple as well a few years ago, where they in the end settled. So yeah, I think this is the thing when you're so popular and so big, and you have these kind of lock-ins, right? Because they can say whatever they want. These are lock-ins, and nobody likes lock-ins. Customers neither. Of course, they can get a long time away with premium products, but I'm not surprised that this happens as such. But from a revenue point of view, I'm not concerned at all. So I don't expect the price to react that strongly, and if it does it, I think it's buying opportunity.
Yeah, but come on, Apple were taking the Mickey, as we say over here, a little bit, 30% on revenue just to use their payment process. I mean, it's too much money. They could have just done a regular fee, maybe 5-10% or whatever the norm is, and nobody might have complained. But taking a huge chunk of somebody else's revenue just to provide a service, a payment provider, I think they're shooting themselves in the foot, really.
Well, it's capitalism, and if they would have done over all those years 5%, they would have probably had less revenue. So it's just, I think they probably they have an analyst there that puts it in an Excel sheet or a Google sheet, whatever they prefer, and then they just probably calculate. And if they are smart, they also take the risk assessment in it of litigation cases, and
Oh, come on. I'm an engineer. These people that sit there in spreadsheets and make forecasts, I mean, it's bullshit. Like, it's easy to put stuff into a spreadsheet and make it sound rosy and pretty, but I mean, 30% is a lot of money. How can they possibly think long term this is the right thing to do? Companies are clearly not going to like this. Obviously, Epic Games, they're big enough that they could fight this. But as you said, it's going to be a landslide now, and whatever 30% people will 100% move to a cheaper option. Why wouldn't they? So
If they can, yeah, if they can,
well,
and
they
yeah,
can. The ruling says they can, so
yeah.
they will.
Well, let's see. I don't think it will impact Apple in materially. If you think also the revenue growth that's pushing this company up, so it will be a blip on the radar, I think. But fundamentally, it means a big thing, yeah, because it sets a precedent, and also maybe for other services, for maybe even for products where it's monopolistic. Because if you go for Apple, it's even they take away your what is it, the socket for your earphone, and they make the USB charger, and you need to pay extra and $250 for those butt plugs in your ears. So it's this is Apple, but we know it, and people love it. Yeah.
Yeah.
So
Well, I must say that the court did rule against Epic and say that they could not demonstrate that Apple were operating an illegal monopoly. So from that
yeah,
point of it, they couldn't prove that. But as you said, it is setting a dangerous precedent, and who knows where it'll stop. But I mean, look, I'm not an Apple shareholder, so I honestly, it doesn't bother me if the price drops. But I think it's only fair that Epic won this battle. Apple
yeah,
make enough money; they have enough money in other jurisdictions that no need to beat up the little guy, I suppose. So, no,
exactly.
fair play to Epic Games.
Yeah. Well, and I'm an Apple shareholder, full disclosure, but I bought once few shares, and they just went 4 or 5 times more over time. So it became a large position. But to be honest, I'm not so focused even on Apple in my portfolio. It's a really low yielder. It's just on price appreciation. It's there, but I don't intend to sell it anytime soon. It's just a well-run company with Tim Cook, and for this, I'm not lying awake at all with it. Okay. Oh, by the way, what's good before we start with the main topic? I want to actually call out that our Facebook group is quite well growing. I think we had just 150 followers like just a month ago. We're now on 250 followers. So many people are joining the Facebook group. It's not so active yet from a point of view that people are asking their own questions, but people are starting to get engaged. So if you're interested to also engage with us, just join the Facebook group. You will find it by searching for Dividend Talk. Then you can just join. I think you need to ask 2 questions so that we keep all the spammers out. But feel free to join. And if you have questions to us, you don't need to wait for the show. You can just post them directly. We will pick them up if they are interesting for the show as well, or we answer them directly. It's our intention just to make it a community. It's with European flavors, so there are more Europeans in there. So you might even try to ask these nasty tax questions to people that nobody always feels 100% comfortable with.
Nice. Okay, so we might as well then jump straight into our main topic. We're going to pick a couple of companies each that are dividend aristocrats that we like, but maybe people don't speak about them as much. Certainly not in the Twitter land or on Facebook. So do you want to go first and pick your first company that you chose?
Yeah, so to be clear, this is a European aristocrat. So I'm choosing Coloplast. So Coloplast is such a company that I'm often looking at, but it always feels expensive, and it is expensive. So it's not, I said, something that I'm currently considering to buy. That to be clear, but I think this is such a company that could be on many people's radar for when the time is there to pull the trigger. So Coloplast is almost already like the name suggests. It's a lot about plasters, but then on wide industry scale. So it just manufactures, how you say it, these medical devices and services for wound care. I don't know how you say it in English for wounds. But if you're ever in hospital and they put these big plasters on you, it might be from Coloplast. Let's say it like that. Yeah, you're laughing at me, but I'm struggling with my English here.
It sounded like Harry Potter when you're saying wands. Wands, yeah.
So how do you say it in England?
Uh, wound.
Wound. Okay,
Yeah,
so these
wound.
are plasters for wounds, and the company is really, really big. It's currently making 19 billion in revenue, and just in 2014, it was still making 14 billion in revenue. So it's growing quite steadily and even rapidly. I would say they have currently a dividend growth streak of 28 years. The share price is around 1,100 Danish crowns at the moment, so it's a Danish company. The yield is 1.6%, so it's not a high yielder, and it also, or one of the main reasons, is because their price to earnings, the forward price to earnings, is around 45. So this also tells you a lot that the company is overvalued, in my opinion, by these metrics, but it has to do a little bit with their growth and their potential as well. The 10-year dividend growth rate is more than 20% on an annualized basis. So that's really a fast grower. And the last year, the dividend growth rate was 6% because it slowed down a little bit. The forward payout ratio is currently 74%. I just love this company. It's one of those companies, if you would do a back test on the Noble 30 index, it's the highest performer, both in price appreciation and in dividend growth. So they had an amazing decade or 20 years even behind them. And I don't see them necessarily stopping. They're still expanding quite a lot. Of course, their growth have slowed down a little bit, but it's still growing. So I love this as a company. I just don't like it as a stock at where it trades now. It would literally need to drop 40% or something like that for me to become interested in this company. But I think it's a company that we never hear about. I don't know whether it is because people mainly look at the yields and that it doesn't pop up on screeners. But as a company, it's a great company. And again, a Danish company, again, in the healthcare industry, like Novo Nordisk, as an example. So it's really interesting, this one for me.
Yeah, I've seen this company, and the reason why it doesn't show up much for me is the currency. Um, I tend to look at euro, and it's what it kind of throws me off Swedish and Danish companies as well, because you're looking at different currencies in both, and the conversion rates and such. So I already have exposure to the US dollars, and putting more currency in and trying to track that is an actual nightmare for me. So
Yeah.
that's probably one of the reasons why. And as you said, it forward PE ratio 45. It's I'm never going to buy something like that. But
No.
in terms of moat and what they do, I'm well aware. I wrote an article about the top 10. I think it was the top 10 or 15 European dividend aristocrats that's been featured on a lot of big sites. But they were, I think, my second or third pick on that. So
Yeah.
it's a company that I really like you, but it's the currency conversion that gets me.
Yeah, no, fair enough. So that was mine, the first one. How about yours?
I am going to pick one, and I think that the kind of capitalist might like this because he's been beating this company, beating the horn quite a bit lately, which is AR Products and Chemicals, which is ticker APD. So for those that don't know, obviously the key is in the name, what they do. So they're the world's largest producer of atmospheric and processed gases. They serve lots of businesses in industrial, technology, energy, material, nearly all sectors. So they serve pretty much every sector. And the three main business units are industrial gases, America industrial gases, which is the same only in America, and they are also have the Asia branch of that as well. So pretty much any industrial gas, these guys are on top of it. What I do like about these, first of all, they have a 39 streak history of dividend increases, but the last dividend increase was 11.9%. Like you, I suppose all these companies, they're quality companies, and maybe one of the reasons why they're not spoken about a lot is because of how expensive they always seem. Um, Typically, this company always seems expensive. So I think that over the last 5 or 6 years, their average PE ratio would be mid to low 20s, which is quite high. If you go back as far as maybe 2011 and 12, it was about 15 or 16. But since then, they've always been in the high 20s, and right now the PE ratio is about 30. So again, quite expensive for what you're buying. But what you get with this company is you're getting a company that is focused on one area. I believe that their competitive advantage is that it's just that, like, it's very hard to switch from a company like that. So once you have this in, the switching costs are high, and it's not easy to find a similar company in your area to get what you need. So I love companies like that. As soon as you're locked in, it's almost like a lifetime contract. You're not going to switch too easily. So it is a clear winner for me. The returns, including dividend and share appreciation over the last 6, 7 years, has been phenomenal. You're looking at least 10 to 15% returns every year. So from those looking from a growth, capital appreciation, or total return point of view, they are very, very strong. What have I missed? The dividend yield at the minute is quite attractive, actually. It's 2.23. It's not the highest yield, but I suppose it's that valuation for me, which is a killer. But I think they're a quality company. They have a moat that it's hard to replicate. You can't disrupt that industry too easy. So if you're looking for a company that is probably going to be around the next 30 years, I wouldn't look past this company.
Yeah, nice one. It's actually a company that attracts me. I just don't have necessarily place for this company in my portfolio right now, but it's probably something I need to look another time into it, because even though the yield is not high, it just needs to drop 20% and meets my criteria, right? And for these high quality companies, it's worth to spend some additional time on it to check if I really want it in my portfolio and be ready for when the price drops. So it's a nice pick.
Yeah, and they're also, I didn't mention this, but they're also trying to get involved in this green conversion, and so I think they have a joint venture now with ACWA. I must check that, but ACWA Power, which are trying to drive this green energy and obviously green gases. So if anyone's looking to get involved in this carbon-free world that we're trying to go towards, this is not a bad point. We've got a proven company that makes a lot of money, that will be around. So that's another way to get exposure into that industry.
Cool. Nice one. So then let me take the next one. And it is also an American company now. It's called Polaris, and it's a manufacturer of motorcycles and snowmobiles. That's what most people know it from. And I find this company quite interesting as such, because usually I'm not so interested in car manufacturers, but how I look at these are more like luxury goods for people that maybe live in a bit less urban areas, more in the outskirts, where like where I live, it's cool to go with your mountain bike through the forest or something like that, and this kind of equipment is perfect for that. And I think as those areas also might get wealthier in some regions of the world, I think this is what one of those secular growth trends is for a company like this. Now, you can imagine in the beginning of the pandemic, they had a quite tough time, of course, with sales, because people had other things to worry about. They couldn't even go outside. But since then, it has been picking up quite well again. Although, if you look at the whole of 2020, their sales were actually quite good, because people probably used their, the money they got from the American government to buy some of this kind of equipment. Yeah, if they didn't need it for themselves. So sales was good last year, but I think it's fair to compare this company rather with the 2019 sales and take some of the 2020 sales as a one-off from that point of view. And if you look at that, it's nicely growing, I would say, if you take out this hike. They have a dividend growth of 26 years. The share price is around $120 at the moment. It is not the biggest company. It has a market cap around $7 billion. I wouldn't even know how you can make a 100 billion company out of this unless you wait 30 years for inflation. The yield is currently at around 2%, 2.10, but it trades at a low price to earnings around 12, because I think like 4 or 5 years ago, it was still trading around, having a net an earnings per share of around $5-6, and now it is around $10 earnings per share. So quite some growth in net income if you look at it. 10-year dividend growth of 11% annualized, and the last year 1.63, and I think that had a lot to do with the pandemic, a more conservative growth. But the forward payout ratio will be around 30% going forward. So the company is called Polaris, and the ticker symbol is PII. I repeat, PII. And yeah, I find this an interesting company. Not something that I will probably purchase, but this is also one of those companies that often pops up on my screeners that I looked into several times, and I actually never hear anyone talking about. Although I think their business model is quite solid, and I think that they will still have lots of sales going forward. I think there are just many people passionate about these kinds of vehicles, and specifically in the areas that are just growing in wealth. Toys for boys, and that's what they
Toys for
sell.
boys. Yeah.
Yeah.
Yeah. No, I mean, there's obviously a huge market for that, not on this side of the Atlantic in Ireland, but I could imagine Canada and as you said,
Exactly.
parts of America would do quite well in this. No, nice company. Not one that I've actually heard of really. So nice pick.
So what's your the last one? Which one have you chosen?
So the last one, actually, I'm quite surprised that I don't hear more about, because when I started looking into this, I think two days ago, these propped up straight away, and I can't believe I've never looked at them before. And that's Stanley Black and Decker, so ticker SWK. I mean, when you think of power tools, there's a few companies that spring to mind. For me, at least, would be Bosch would be one, but Black and Decker are definitely up there as one of these. They are the dividend kings, so they've been paying dividends or increasing dividends for 54 years, and the last increase was still a whopping 13%. I mean, that's incredible. I would have expected the growth to slow down. The one caveat I have with this company is that they are certainly not recession proof. So if we have some sort of crash, if we have some sort of bubble bursting, I would expect this company to perform horribly like it did in 2007, 2008. But since then, it has recovered. I mean, earnings per share back in 2011 was 5.24. It's now over double that at 11.50. So they've been increasing it absolutely perfectly every year after the recession. But like we said, if we're with these high valuations and we expecting markets to crash, maybe they're not such a good option. In terms of their own valuation, I actually think they are quite attractively valued at the minute. So they typically trade around 15 to 16 PE, which is what they're at now. So they're keeping in line. Dividend per share has grown from 164 in 2011 to 316 now. I mean, that's incredible. I think that's about 8% annually, maybe. What else have I to say? Their dividend yield is 1.69% actually, which is quite low for me generally. But their growth rate more than makes up for that. So I think they're a quality company. They make really good tools that's used all over the world. I would just be worried about maybe inflation costs, and if there was a recession, how this company would hold. And if we were in a recession, or if we were in that and they drop significantly, I probably have no problem in buying them then. Maybe not so much now, but I'm keeping them on my watch list.
Yeah, it's a nice company, and I must say it does pop up from time to time, but not so much in the European community. And to your point, it's a bit awkward, but they have a really strong brand power, in my opinion. I mean, Black and Decker, I think everyone knows this brand also in Europe, and probably people have this stuff in their home over here in Europe as well.
I mean, as I was a tradesman before, so I wouldn't see these as a premium brand. So if I was buying stuff as an electrician, as I was, I would not buy Black and Decker. But when I'm buying stuff, when I want to build something in my house, I build this desk,
Exactly.
I buy Black and Decker.
It's a consumer product.
Yes, they make really good tools. Maybe not professional quality, but definitely for the home enthusiast.
Yeah, nice one. Well, with these four stocks, I hope we inspired you a little bit, also with a different angle to some of the dividend aristocrats. I think it's always good to keep an eye on these, also to diversify yourself a little bit sometimes in your thinking to see what's out there more, instead of only talking about Johnson Johnson, Unilever, and these kind of major companies. So yeah, good ones. Okay, so let's go to our next topic of today. It's the portfolio review. And today we got the portfolio submitted from Piotr. Hi, Piotr. I met actually Piotr the other day, this summer. He lives over here in Warsaw. We went for a drink. It's so cool that the country was a little bit open this summer. Let's see how it's going forward with the fourth wave. But it's also nice to see his portfolio coming in as a submission. Now, what does he own? And he's quite concentrated maybe in his top five. He has Unilever at 12.5%. He's got PZU, which is a Polish bank slash insurance slash healthcare company, for 12.4% allocation. He's got British American Tobacco at 7% allocation, Ahold Delhaize at 5% allocation, and Rio Tinto at 5% allocation. This is his portfolio, and his idea is to have a defensive one that he can sleep well at night. And he's still in the accumulation phase. And what I also understood when we went for a drink together, he's still in the early days when it comes to not being able to put all the money in that as he would like to, because he still needs to work on his savings rate. So from that point of view, his thinking is, if I got high yielders now, and these companies have all this average of these companies probably around the 6-7% yield in these top five. His idea is that take the most dividends now to reinvest so that my snowball gets quicker, bigger. So that's the thinking here behind it. Instead of focusing on low yields, stashing a lot of money in it and hardly seeing the impact of the snowball in the beginning, of the size of the snowball. So that's the thinking here. And yeah, his question is to share our thoughts about it.
Yeah, and I mean, when I saw it first, I was thinking, wow. I didn't know that the Polish insurance company, first of all, but 8% dividend yield is quite high. It is, as you said, quite concentrated. I think nearly 40% of his portfolio is made up of these five stocks at the moment. But it is important that he is in the accumulation stage, and that is going to happen if you're going to buy, particularly. Look, I don't know how much he does, but if he buys monthly, if he buys even quarterly, you're going to see huge fluctuations. I see that in my own portfolio. One of the criticisms that we get as dividend investors, and I see a lot of from other types of investors, is that we can get focused on yield, high yield. Usually when there's high yield, we know that there's a reason for it, and it is quite risky. So I understand the approach. I understand why you would want to choose your high yielders now, but you have that added risk of a cut. And we've seen that with Royal Dutch Shell, for example. We have a bank here. I mean, European banks are not, I mean, they are liable to cut dividends as well. So it could happen. It is a risk. So I would just be careful. I would just be careful with that. Just be aware of it. I'm not saying it's a bad thing or a good thing, but you do have that added risk there. I understand why he goes this road, but maybe I would maybe mix it up a little bit more. But I think it's a good top five. I have one, two, three of them, three of them in my own portfolio, so I can't criticize that too much. And I know Rio Tinto. Maybe you might speak a little bit later. So no, I think it's good. I think it's a good plan. He has 21 in his portfolio now. I don't know what they're like, but maybe start beefing those up a little bit more to even out the portfolio spread.
Yeah, I've got similar thoughts here. So first of all, I think that if we look at Unilever, British American Tobacco, and Ahold, these dividends are really safe, in my opinion. Of course, you don't know ever what with a company happens, but if they don't do fraud, these are slow compounders. It's not like everyone stops smoking tomorrow. The same with Unilever, the same with Ahold. So these are slow compounders, and they will also slowly decline under normal circumstances. So only fraud or something like that, or a legal lawsuit, would take those down. So I'm not worried about those three at all. I think with PZU, they don't necessarily have consistent dividend growth. So you're in here for the yield. The same with Rio Tinto. They pay bonus dividends, so that's why the dividends are also quite high. But you have a floor in it, and this floor is still high. So they rather pay out a share, a percentage per share. So I don't consider them necessarily dividend growth companies. But over the last decade, they have been growing. But I think that's also more because of the bull market we live in. I understand what Piotr is doing. I would say now, once you have this course set up, also knowing with 21 stocks, there's a part of the snowball which is also important, and that's dividend growth. And if you look at most of these companies, I don't expect more than 6% on average on these 5 dividend growth going forward. Yeah, and it's an equal important factor when you think about dividend reinvesting. So I think Ahold qualifies for this kind of growth rate, probably British American Tobacco. The other 3, I don't really see them hitting the numbers, specifically also not if we will have some market headwinds. So from that point of view, I would start looking maybe at around the 3% yield, 2.75% yield, with companies that might have more like... I say it's something around 8% dividend growth going forward to mix it a little bit up, because you will also need to benefit from that point of view from the snowball. But I think this is a really good start with the high yields, as long as Piotr is aware that it might slow down later, maybe some of the dividend growth from that point of view.
Yeah, does Dividend Wave have a one-pager going around with high dividend yield and a low dividend yield but high dividend growth, and compare, and you can see that the dividend growth really, it takes longer, but when it overtakes the high yielders, it really snowballs. Certainly check that out. Well, actually, what I'd love to know here is how you plan to average down the yield with dividend growers. I'd love to know how you plan to do that. Is that by selling parts of the high yielders or adding extra capital? But I would love to know. Just personally, I'd love to know that from myself, because that's to me, that's very interesting. A very interesting approach.
Yeah. Okay, good. So thanks, Piotr. I hope this helps. Let us know what you think as well. You know where to find us on Facebook or Twitter. And yeah, let's go to some of the listeners' questions.
Cool. So I'll ask the first one from Kasper Kornak. And he has asked us, stop laughing, I probably pronounced that wrong, but he has asked us, do we think a market crash is happening soon? Given the fact that Yellen warned about possible October default, bad unemployment data, and some banks downgrading US equities.
I have no clue if a market crash will happen soon. I think that it would happen soon already since 2014.
Yeah, what we're on episode 64. I believe since episode 2, maybe I've been saying I'm expecting a crash. So maybe when I say we're not going to have a crash, it might actually crash. But I mean, look, I think we made no secret, or at least I have, that the valuations are too high. The pandemic covered a lot. There was handouts given by governments. The Fed has been printing. That all has to come to a head at some point. We don't know when. We don't know what the trigger will be. We can't possibly say it's going to be October for certain. We don't know. All we know is that something will happen. How bad it'll be, nobody knows. But we'll just keep chugging along and see how we go. But
so for me, the more interesting question is, what if it happens? What will you do?
I spent all my money on a car there last week, so I'll be quite disappointed if it happens soon. It's going to take me a couple of months to build back up my war chest, but I'll just keep going the way I'm going. I'm just still going.
But that's the thing, right? Because I would not sell a share in my portfolio unless there are dividend cuts. So for me, if a market crash happens, it doesn't really matter. Actually, I would get excited. Yeah, it would be like pop up the champagne and get some additional money at work.
Well, I wanted to wait at least 6 months until I build up my war chest again. But like you, I won't sell. And a dividend cut doesn't mean I'm going to sell either. it depends
No, but there's a
on
high likelihood, right? If the
yeah,
fundamentals changed with that,
yeah,
like Disney did, right? Disney at the time said, "Guys,
yeah,
you're not going to see it soon. We need to invest it." Yeah, then the whole investment thesis changes.
yeah. But we'll
Yeah,
we'll cross those bridges when we come. But certainly, I won't be selling just because of the crash. So
yeah. Okay. Then Rits Wildevank asked on Facebook, he would love to hear your opinion about the upcoming Scholt Energy IPO. So it's a Dutch energy company, kind of a play on the green stuff, the green
yeah, so
trend.
I didn't know much about this company until I saw this question. First thing I did, went onto the website. Website looked okay. Went on to the investors relation page, which is I always do, and I got nothing. It was blank. It was just a footer and nothing else. I asked you to do the same. You got the exact same as me, and honestly, that really pisses me off. I just, I mean, it's a simple thing these days as investors. You want to get the data easy, and I don't understand it. But in terms of what the company are trying to do, they seem to be in this green transition. Look, it looks great. I'm not really into IPOs or into new companies like that. I would much rather go with a company such as, I don't know, maybe Encavis, which was recommended by a guest on our show before, who are also in that space, but they are a more mature company in that area. So I am more than happy with companies coming in and paying what, an 80% dividend payout ratio is saying. But for me, they'd still be too new a company for me to look at.
Yeah, same here. Okay. So the next question is from Dividend Dane, and he says that we have seen a slow and gradually receding market these past couple of weeks. And September is typically a worst performing month. So taking those two things in consideration, should we put a break on just buying as usual and wait for an opportunity?
So I love this when September is the worst performing month, and in the dividend day chat, everybody was speaking about how often they check their portfolios, and I mean, I don't really check. You said
Yeah,
to me before the show the markets are down, and first thing I said is, "Oh, are they?" Because honestly, I
yeah.
don't bother checking. I don't need to check. That's why I'm a dividend investor. So, if September is traditionally the worst performing month, mm, for me, that's probably a good time to buy if things are
Well,
dropping.
yeah, we buy anyway every month, right?
Yeah,
So
yeah.
yeah, I've the same. It's what is it? Sell in May and go away, but remember to come back in September. And then now they tell me that once you come back and you initiate your portfolio, you even get the worst month straight on it. Why isn't it called like come back in October?
Hey, just skip October. Why not go to December or wait till after
Yeah,
Christmas?
December. Yeah, but in December you have the tax harvesting, right? So then
Yes.
you get that again. So and then in January and February you also get this time. So it's like, yeah, it makes all no sense for you. For me, it's the same like you. I don't check my portfolio a lot. Often I also get surprised that markets are down. I made the joke in the dividend day chat that usually I'm aware of sudden price drops because they start pinging there, and I like to be engaged on Twitter, so that's why I know. Other than that, I wouldn't also really know. So dividend day, yeah, uh, suck it up with this answer, buddy. Next one is Thiago, also one from the Dividend Day chat. So, how much of an impact do the macroeconomic factors have on your willingness to invest in a company? Are you not concerned that lagging European economies will drag the performance of European companies, making non-European companies more attractive?
This is like a question that you would ask a professional investor, isn't it? Someone that their job is investments and they look at all these macroeconomics, and honestly, that is so far out of my league. It's not even funny. I'm a small dividend investor. I look at cash flow. I look at earnings, and that's about it. I read the news and I don't pay too much more attention than that. So for me, yes, we know the valuations are different. We know the valuations are, the returns are a lot less in European companies than American companies. But we look at dividends, and that's where our money, our cash flow is coming from. And my average yield from US companies is not too much more than European companies at the moment. So I don't pay too much attention to macroeconomics or anything like that.
So the problem that I have with the suggestion in this question is the simple fact: if I look at Unilever or if I look at Ahold, two big positions in my portfolio, even Danone, they get most of their. So Ahold, 65% of revenue from the US. Danone, majority outside of Europe. I said also Unilever, majority outside of Europe. So, with these kinds of global companies, it's the same as having kind of a world index. Yeah. Specifically, they are consumer staple. So the only risk you have here is that, for instance, the local governance put, for instance, a higher tax rate on it, which suppresses the earnings. But I don't really look at it from the macroeconomic factors. I look at it more from a political point of view, where China is controlled by the government, where companies work for the government. In how is it? In America, politicians work for the companies, and in Europe, it's a bit a mix of those both. That's how I look at it. So if you buy companies that are of global nature in Europe, you don't have this impact. You might have this impact with Vonovia, which is a local real estate play. So not too much worried about it from my point of view. And also the last that I want to say about it, it's not a stock market. It's a market of stocks. So certain companies have their own tailwinds, their own secular growth trends. Think about, how is it? ATN, payment processing. I know it's not a dividend company, but all such companies, they have tailwinds, and there are many of such European companies. Then we just spoke about Coloplast, right, as an example. So it's a market of stocks, not a stock market. That's how I look at it, and that's why I don't need to be bothered about economic factors and such either. That's how I think about this whole topic, because I think he has a point that if you look at the indexes, probably the US will keep outperforming Europe, also because US finds corporate growth more important than population wealth growth.
Yeah, and look, I must say we've spoken to Tiago quite a few times. I read all these articles on his Substack, which are, I mean, they're all really detailed, detailed. So I'm not surprised by this question, and his knowledge and education in business and finance far superior to mine.
Yeah.
I just like to keep things simple and simple as possible.
Yeah. Next one then, from Life with Dividends. And by the way, he has a nice blog. He didn't start too long ago, so I recommend Googling him and check him out. And he writes, by the way, some really good articles. And he asks, in your journey as an investor so far, name one investment decision that has turned out to be great and one that has turned out to be worse. What have you learned from this experience?
Yep, that's easy for me. So one that's worked so far is Walgreens, and one that was not so good was Tanger. Have I learned? Yes. So know what you buy and why you're buying it and why you're going to sell it as well. So Tanger turned out to be a disaster. I bought it at a high price. I sold it at a low price, and it returned to an even higher price. So, I mean, look, it was a mistake from my point. I probably should never have bought it in the first place. And Walgreens, I think I might have just got lucky.
So I'll share you then what's really happened with me. So my best one is Microsoft, and my worst one is General Electric.
Mm-hmm.
And what have I learned from this experience? That I'm even more confused, because I in both I made a bet on the CEO. So with Satya Nadella, I felt like, okay, he's going to push this company into the sky, and I was probably quite naive, but I even fell for the words of Jeff Immelt, who was just a charlatan, and he should have been in jail already by now. So what I learned with it is probably how to spot a CEO better. I made the same mistake with Rick Goings from Tupperware. I don't make those mistakes so easily anymore, because I started to see the window dressing and look at the financial data and the non-adjusted terms more, and then you can quickly see if a CEO is just smooth talking or not.
So that's why you're a fan of Arvind Krishna.
IBM? No, neither. No. IBM? No, don't, stay away. Okay.
Okay, on to Phil's question. So Phil has asked us, what do you think about the DAX extension from 30 to 40 companies?
Not a lot. It's if they need it, then that's fine. I mean, it's an index. Like I just earlier said, it's not a stock market, but market of stocks. So if there comes some more news or more, if these companies get a bit more in the spotlights, then that's nice. It might trigger me to look easier or earlier into it. But for the rest, it doesn't do anything for me. I can imagine that maybe if you're from Germany, that you might feel more pride or something like that around this, because I think Thiago, that we just spoke about, wrote a really nice article on the European Investor Network about the PSI index from Portugal, how it came to a standstill, and they even dropped the name of the PSI 20 because they don't have 20 stocks anymore. This is not nice. Yeah, you would love your country and your corporates to do well, I think, specifically if you have passion for economy. So I can imagine that this is really nice for German citizens, but I don't have that attachment to the German index. It would be more if you ask me this question about the Dutch index, that I would have more I said, emotions to it.
Yeah, it seems like a good thing, though, doesn't it? I mean, they're all pretty well-known companies going up. Airbus, Siemens Healthineers, Porsche, etc. I mean, I don't know how it impacts maybe ETF holders, maybe not of the DAX, but the one underneath that, which I think is the MDAX. So these companies had to come out of somewhere, so they've come from the MDAX. I think they made up a third of that. So how that affects ETF holders might be a little bit different, but like you personally, I have no real opinion on that. Only for it seems on the surface to be a good thing for Germany.
Yeah. Okay. Then we have a question from John, and he asks, "Are you guys at all following the growth in carbon credit markets?" I can tell you, no, not at all. I had once a lesson at business school about it. It was so boring and it was so full of manipulation by airlines and everything that I felt like, okay, not interesting for me. I understood that. I saw an article passing by lately that it was quite growing again, but it's not in my interest. And John, it's simply because my mind is going to dividend growth. I can't occupy my mind with all these kinds of topics as well. So good question, but not for me.
Yeah, I'm the same. It doesn't cross my radar. I mean, I'm pinky in this podcast, so if the brain doesn't comprehend this, then it's not going to come to me either.
Okay, then now you're the brain. Miłosz Markovic is asking, what about European banks, traps or opportunities?
I mean, look, I don't know a whole lot about European banks as a whole. I know about Irish banks, and in what you say, bankers are wankers, that seems to be the case, and they are 100% value traps in Ireland. So if Europe, which I assume they do, follow the same tone, I would stay away from European banks.
Yeah, same here. And even that, I think bankers are wankers. It's not about that actually. Well, also, but why I really don't want them in my portfolio is because, and we saw that last year during the pandemic, the European Central Bank, or what is it, the European institution, they just say, "Thou shall not pay dividends to your shareholders. You're a systemic, bank, so you need to play safe first." So, and I don't want to have a dividend cuts in financial distress. It's as simple like that, and that's when I need to count on it now, not now. So that's why it's not an opportunity for me.
Cool. And then the last question then is from Vladdy Vayner. And this is a really interesting question because I don't know the answer to this, but he says, when you buy American assets, do you take into account the inheritance taxes for non-US residents? The US imposes a 40% estate tax rate on US assets above $60K, exemption threshold on assets of deceased non-residents. Now, I knew about this, but I did not know it was in relation to stocks either.
Yeah. So the only thing Vladi did with this question is trigger me to look it up because now I'm thinking like, oh shit, is
Yeah,
this true?
that was my
And
reaction.
yeah, and how does this work? Also, if I have my stocks in a Dutch broker or something like that, am I shielded off of that or not? I have no clue, so I need to really check this out. So thanks, Vladi, for bringing it to our attention. If you have any link or any information that you could share with us, please do so. It will be really desired. I will even tweet it out so that all the listeners can read it on Twitter and Facebook or Instagram, what this is about.
Yes,
So thanks for highlighting.
For some reason, when I saw a estate tax, I have seen something like this come up before, and I just assumed estate tax was with, I don't know, real estate or some physical assets in the United States. But if it's concerning, as you said, if it's concerning me owning shares in a Dutch broker or so on, then it's quite worrying. Or particularly Interactive Brokers, which is a US company. I mean, I know I've made a switch to them recently, but that could change again if something like this drastically impacted me. Well, not, it won't impact me, but it impact my kids and my family that would have to deal with it when I'm long gone.
Yes, and I think if it's already difficult for us, then imagine what it is for the wife and kids to reclaim the withholding taxes or the inheritance tax.
Do you know what? Now that I say that, that's their problem. I'm happy to keep going the way I am.
Yes, good husband, happy wife, happy life, right? Okay, so hey, this is the end of the session, I would say. Usually we do stock pick of the week. We already shared 4 stocks today. Maybe just what I wanted to share to our community for the people that stayed this long, an extra bonus. I just wanted to let you know that I bought some additional Allianz shares today. I also initiated a position in Rio Tinto. I made a video about it last Sunday about some high yield stocks, and I liked what I saw about Rio Tinto. And I sold an option on Unilever with a strike price of 44 euro and how is it expiry date in November. So yeah, I'm really happy that prices came a little bit down this week, so I could average a little bit down on Allianz. And yeah, I'm really excited actually about Rio Tinto because it will be now complementing my BHP bulletin. I've got the 2 leading companies in the materials sector, so now at least if one performs or outperforms, I have them both.
Yeah, it's a good strategy. Materials and industrials are 2 segments I need to get my act together on. So maybe I'll check out your video.
Super. Okay, so thank you everyone for staying so far with us. Lots of questions, lots of engagements. We really like it. As you could hear, we cannot answer maybe every question to full extent. We might not always agree on everything, but that's why this is an opinion podcast and a little bit unsalted, so I hope you don't mind. And for the rest, I just want to thank you as well, EMF, for this great show again. And all the rest, I wish you a great week and up to the next show.
Okay, see you next week.